In this video, traders are going to look at Dow Theory trading signals on a long-term basis. Stay tuned. Hey traders and investors, a very warm welcome to you. So this is more for the longer term traders and probably investors. Now Dow Theory, when back tested, beats a lot of strategies. Very, very simple, very, very effective, but obviously not that many signals. I'm going to look at it in a short term in a second, but let's look at the broad kind of theories that Charles Dow put out there as to when we should execute a buy and a sell. So the first thing is the primary trend is stalled by a secondary reaction. So the primary trend is the major kind of annual, yearly, should I say, trend that's going on for a long, long time. I'm going to identify that as this part here. Okay, so we've got to drive up. It's a good long trend and assume that's come down from way down below and it's pushing up to highs. And it gets interrupted or it gets stalled by this secondary reaction. Often we get a push and we're going to pull back basically, which is weeks or months when we're looking at this bigger, longer time frame. So drive up and now we get this secondary reaction that's against the trend. Okay, now once we hit that low at 0.2, we're going to mark it, we get a bounce back up. So we get a reattempt to take out the high at 1. So we've got a high, we've got a deeper pullback, and we get a bounce. Now, Charles Dow suggested that should be a 3% bounce at least. So this is going to be a pretty hefty pullback. And I think we can probably get rid of the kind of numbers and quantities for now because markets are moving in different conditions. And I think that perhaps back then the numbers were a little bit different, weren't they? We had much more extreme moves when things were moving as liquidity was less, even though we have had flash crashes now. But regardless, I still think the theory of it's fine. So not necessarily think of the 3%, but the important thing is it doesn't come back and break through the high. It drives up, it attempts to drive up, it fails. This is where we come in. After that pullback, the prior low is then broken and we're looking to sell. So as the market comes back down, it breaks through the prior low that was formed from the counter trend, secondary trend reaction. Fails the attempt to push through high, comes back. That's your short entry, or as Dow would say, it's your sell your long that you've already got. So this is kind of some fundamental theory that we use with many kind of trading setups today. We use the theory of pushing to high, pulls back, can't go up to a high, taking the low. This is kind of bread and butter stuff. Now some people kind of frame it and it's head and shoulders kind of comes from it's a little bit slightly different, but it's the same kind of thing, isn't it? It's where supply demand has shifted. We push up, its demand comes back in, push back up again, supply comes back in now, more supply, no buyers step in at the previous low, and then there's the entry. Now, there is an argument to say that might be a bit late. You know, if you're selling here, you might be a bit late. But the whole point of this is, guys, is that we're not think of it from day trading perspective. Let's look at some day trading stuff in a second. Think of it from an investing perspective. The last thing you want to be is shaken out. So while we might postulate and say, okay, well, actually, hey, we're better off kind of selling it when we fail to make a lower high here because we want to get the meat out of it. No, because actually this still secondary trend could kind of chug along here before it finally breaks out the high. For it to be a genuine signal from the Dow Theory perspective, we've got to break that low. And yes, it's going to be late, and yes, we're going to give a lot back. And if we're talking about these numbers here, like 3%, that's a big thing to give back over the move. However, it means that we're going to stay in for the whole primary trend, which is the whole point of investing or swing trade on a long-term perspective. We want to milk that primary trend as much as we can. We don't want to get pulled out by secondary action because they always do happen. And this is the kind of thing that the Dow said, you know, we do get these reactions, but when we get this pattern with the reaction, it's time to have a closer look at it. So and come out of the market. So there's that. And also, guys, we can look at this from a perspective of, you know, a shorter time frame chart. We've got the classic drive up, you know, pull back, fell to high, and of course people are going to say, well, it's Elliott wave as well. All wraps around the same kind of thing. It's the same theory, and if we see that even on a 15-minute chart, okay, I'm sure Charles Dow not very happy about us saying this, but it's the same kind of thing. There's your position 1, there's your position 2, you failed to come back up. 3, there's your high, same kind of thing. The primary trend is here, secondary trend is here, comes back, attempts to push back and break this high, doesn't, rolls back over, and there's our sell short or our sell long, whatever we're trying to do. And also, if we flip it on its head, if we can just imagine going the other way around, we've got the low, we've got the push back up, we've got the fail, and we've got the drive. So it's the same kind of stuff. And I'm sure this is not new to you guys, and there's our long entry there. I'm sure this is not new to you, but I think it's interesting to see that this goes back from so long ago that it just comes down to supply, demand, and human nature. And if we just drill into that very quickly now, hey, look, everyone's happy, everyone's good, we're chugging to highs, all good, everyone's making money, all the bulls are making money, everyone in the trends are making money, we're happy. Pulling back, secondary trend, a little bit nervous. The guys are in from here onwards and now losing. They might be coming out, might be additional sellers coming in who have ridden this wave, whatever it may be. A little bit of shorting, a little bit of profit taking, whatever it may be. No problem. It's a normal pullback in a trend. We see it and the guys are not worried about it. Unless it's weak money, they're not going to get pinged out by it. Attempts to drive back up, all very good. Psychology is great. We've got a lot of demand coming back in. We're just a pullback, go back up to highs. A lot of people start buying back into here, or people who hadn't bought on the major trend will buy on that. Now we come to push back up. Now we get to the interesting, juicy part. This is where things start rolling against us, rolling down. All these guys here are thinking, you know what? I don't like this anymore. We didn't break a high. The pain was not exactly great here. I'm going to start to sell. So that causes a bit of a cascade. Anyone who bought this here thinking we're going to new highs is now in trouble. Anyone looking at the bigger picture as well is perhaps seeing this as a reversal if they're studying the Dow theory. Coming back, and then of course as we break that low, people are hoping that is going to hold. A lot of people are probably buying that in expectation for that to hold. Nice support there. It's good support too. It's going to hold. Doesn't hold, bang, we get the cascade lower. And a lot of people then start to liquidate, and perhaps we have a change in primary trend. Of course, that's the textbook thing. Often we might get a fake out, we might get multiple variations of this, but if we can frame all our approaches in trading looking at the bigger picture like this, which actually from time to time, I know I'm guilty of being too blinkered right down into short term, but if you get a 15-minute look at that as a daily or even a weekly and see how the bigger trend is affected, because on a higher time frame, forget the lower time frame for now, just illustrating from a point that we could trade it on a lower time frame. But if we're looking at a higher time frame, there's going to be things that affect this. This isn't just short-term movement. This is going to be, hey, we've got a bullish economy. Hey, we're worried about the economy. Hey, we're not too worried about it. Oh, yes, we are. Data's come in that showed the economy shrinking. For example, there is going to be a catalyst that causes that, because one of the things that Dow says is if we don't have that external catalyst against the trend, we're going to continue. So by the very nature of this, this is a good way of identifying using price as to perhaps the fundamentals that are shifting people's perception of value of this specific market. All right, guys, Dow Theory trading signals. See you next one. Take care. Bye-bye.